Bloomberg Audio Studios.
Podcasts, radio, news.
I accept that this is a big and a substantial budget. It wasn't the budget that I was expecting to deliver when I became Chancellor on the 5th of July. I didn't think that any government would be so reckless.
Rachel Reeves defending her budget plan to rebuild Britain. Those who'll need to pay for it aren't so sure. You're listening to Bloomberg UK Politics. I'm Stephen Carroll.
And I'm Lizzy Burden. Welcome to the programme. It is the morning after the day before Halloween budget we were warned of. Would we be spooked?
Were you scared?
I actually had spiders in my hair at Westminster, but that's another matter. Rachel Reeves announcing a fundamentally bigger state, £40 billion in tax hikes. That's the most since Norman Lamont in 1993. We saw lots of the tax hikes that were trailed. The increase in employer national insurance contributions, rises in inheritance tax, capital gains tax, all to fund extra spending. And yet, Stephen, the fiscal watchdog, the OBR, predicts that the package is only going to marginally increase growth in the short term. And by 2029, actually, the economy will be smaller than if it was under the Conservatives. I
mean, look, undoubtedly, it's businesses that are going to be paying a lot of the upfront costs of this as well, particularly given the increase in the employer's national insurance. The CBI, Business Lobby Group, describing it as a tough budget for businesses. Interesting, though, that we did see in a lot of the reactions to business groups, and we spoke to Michael Moore, for example, who's from the British Private Equity and Venture Capital Association earlier, saying that they did feel they were listened to in the run-up to the budget and sort of an acceptance that there were going to be quite a lot of difficult decisions. They're not happy, most of them, about the increase in that particular payroll tax, increase in the minimum wage, of course, going to hit many businesses as well. But there's sort of a feeling that perhaps it could have been worse.
Well, interestingly, that increase in the minimum wage is also likely to feed through to inflation, according to the Office for Budget Responsibility. And you've got that £142 billion increase in borrowing as well. So this is why traders have pared their bets on Bank of England rate cuts after the budget. In other words, this package of measures means that the Bank of England can't cut rates as fast. If you look at the swaps markets, it's been about 100 basis points of cuts over the next year compared to 115 basis points of cuts for the Fed, 119 for the European Central Bank. And that's despite...
There's a lot of basis points, Lizzie.
It is, yeah. But look, it's despite the Bank of England making a slower start to the easing cycle. And this is why we had such a market reaction in terms of gilts. Rachel Reeves sat down yesterday and things had been pretty sanguine up to that point. But then you saw this ferocious sell-off and it's continued on Friday morning.
You know, it's worth saying this is nothing like what we saw in the aftermath of the Liz Truss budget. We're talking about moves that are much smaller by move of magnitude, but nonetheless creeping up borrowing costs, and on a normal day it would be considered quite a big move. But we're not quite back to the territory of 2022 just yet. We've been discussing all of this with David Miles from the Office for Budget Responsibility. He's a member of their Budget Responsibility Committee and he spoke to us earlier.
I think what the government's done is introduce a budget with some big changes. I mean, there's a big increase in government spending. Government spending is about £70 billion a year higher than it would have been on the previous government's plans. That's a huge number. There's 70 million people in the UK, so it's like £1,000 a year for every person in the UK. So typical household, maybe there's 3-4 people in it. There's 4 people in it. That's £4,000 a year more government spending every year.
But it's less than expected, right? Day-to-day real increase in spending. The expectation was 2%. Is it that it'll still feel like austerity?
Well, it's a large amount of extra spending relative to the plans of the previous government, which would have seen a really quite major squeeze on spending on day-to-day services, but also a big squeeze on government capital spending, government investment by the government. So relative to that, it's a big move, and that necessitated big changes both in taxation. There was a large increase in the tax takeout of UK GDP, and also a big increase in borrowing. Now, you could describe that as just a decision that the services of the state would have declined in quality, and therefore the government needed to spend more money on them and needed to spend more on capital goods. And that, I mean, you could call that a political decision, an economic decision. It is what it is. That's what they've done. You can't do that without either increasing taxes or increasing borrowing, and they've done both.
The effort and the aim of Rachel Reeves was to rebuild Britain. There is a capital investment programme involved in this budget as well. Can you talk us through what is the actual net effect of that on growth and how long we'll have to wait until the UK starts to see the results of it?
There's always going to be a time lag between an increase in the kind of things that government spends money on, the road network, building hospitals, power stations. That stuff takes quite a long time to build. So you spend the money and it may take a couple of years before it actually is a usable piece of equipment that starts affecting the quality of life in the UK and UK GDP. And that's what happens in our projections, our OBR projections about the impact of higher government capital spending. Starts coming through in the relatively near term, but doesn't have a major impact on the productive potential of the UK until 3 or 4 years beyond that. So by the end of our forecast horizon, the 5 years that we look at the impacts of government policy, it's had enough of a positive impact to offset some of the negative impacts that are almost inevitable when the government increases taxes substantially and borrows more money, which puts a bit of upward pressure on interest rates. So the long and the short of it is that by the end of 5 years, the positive effects of government extra capital spending offset some of the almost inevitable negative effects of raising more taxes and interest rates being a little bit higher. Beyond that 5 years, if the government then keeps investment at a higher level, you begin to see more of the payoff. But that's kind of some ways down the road.
Yeah, that kind of feels like this decade of a national renewal is more of a plea than a promise, that they need to be in government for 2 terms to make a difference. The other statistic that really stood out to me from the OBR report was that the economy was projected to be 0.1% smaller by 2029 than you'd forecast in March. When you compare it to the Conservative plans, so surely, I mean, this is just an objective analysis. We would have been better off if we'd kept Rishi Sunak in post.
Well, I mean, essentially, the forecast for 5 years down the road is basically that GDP is about where it would have been. So it's neither larger nor smaller. I mean, the 0.1% is kind of negligible relative to the uncertainty in the forecast horizon. So you could look at that in a couple of ways. You could say, well, that's a bit disappointing. This is a budget for growth. It doesn't seem to be doing it. But I think you've got to factor in these time lags between raising the taxes, spending the money, and it actually having an impact. So it would be perhaps expecting a bit too much for government infrastructure spending for the long run to be having a noticeably positive overall impact, given that it necessitates rising taxes as well, to have an overall positive impact at the 5-year horizon. But it's only really beyond that, if you persist with higher levels of capital spending, that you start to see much of the payoff.
And what about the inflationary impact? Where's that coming from the most? Because if you look at the gilt market reaction yesterday, yes, there were international factors as well, but it seems like traders reckon overall this budget's going to slow Bank of England cuts, and I'm wondering whether actually people are going to feel worse off because of that as well.
Well, it is plausible that interest rates might be a bit higher than they otherwise would have been, and on our OBR forecasts, we sort of factored in a level of interest rates about 0.25% on average over the next few years, higher than it otherwise would have been without the big budget measures. I mean, that's not entirely trivial, but in the context of interest rates, sometimes a few years ago they were 0, now they're 5.5%. So 0.25% is not exactly a game changer, but it's not trivial either. And the reason that that's happened is that, in a sense, the government's got to make room for its extra spending. The government's going to be spending 2% of GDP more than it otherwise would on the previous plans. You've got to make some room for that in an economy where there isn't an awful lot of slack. Now, the government makes some room for that by increasing taxes. So that takes money off households. They spend less on consumption. There's increases in taxes on companies. They spend a bit less. But half of the extra resources going to the government come from borrowing. So you still need to reduce somewhere some private sector spending to make room for a state that's going to be 2% of GDP bigger. So that's partly squeezed out by slightly higher interest rates a bit higher inflation. Higher inflation cuts people's real disposable income. So that's how the government, in a sense, makes room for a bigger state. And there's no other way to do it, really, than reducing private sector spending on investment by companies, on consumption by households.
Is that
and
one
also
for
us
one?
borrowing a bit more internationally.
Just to understand how one crowds out the other, is that a one for one exchange? Essentially, is you know, does an extra pound of public investment crowd out an extra pound of private investment?
Well, no, not quite, because the crowding out, if to use that term, the crowding out needs to crowd out, private consumption. You could increase imports a bit as well to make the extra resources available to the government. And there is some crowding out of private investment. I wouldn't say it's one for one. In fact, on our forecasts, if you look at the sum of business or private investment and government investment over the forecast horizon, the sum of the two is a bit bigger.
I'm looking at the government borrowing costs, gilt yields going up further this morning. I wonder the repricing that we're seeing on markets and the impact that has on the fiscal outlook down the line. If we end up with sustained higher borrowing costs, will that materially affect the outlook by the next budget?
I mean, when you have a state like the UK, and this is not unique, it's true of many European countries, it's true in the US as well, when the stock of government debt is about the same size as GDP, then a sustained increase in interest rates of 0.5% will increase government spending in the long run on interest by 0.5% of GDP. So that's a big number. 0.5% of GDP in the UK is about 16 billion pounds. So it is absolutely the case that if there is a sustained increase in interest rates, that has a very material impact on government spending on interest.
Yeah, and I suppose there's also the uncertainty around what happens after the US election if you get Donald Trump in the White House and this is just a much more inflationary world. But I just want to ask you to settle something for us. You had Rachel Reeves really getting reprimanded by the Speaker of the House for over-trailing this budget. Do you think that it was irresponsible to trail most of it ahead of the actual speech in order to calm the market?
Well, I think it's something that we've got used to in the UK, not just over the last few years, but probably over the last several decades, that governments give hints. I mean, sometimes they're accidental leaks, sometimes they're not so accidental. It's a bit difficult for us in the OBR to work out. It's not our job to try and figure it out. But
it felt quite deliberate.
I think it's probably not unusual. We've seen these kind of leaks before. I mean, the days going back many, many, many decades when a Chancellor of the Exchequer accidentally said something on the way to Parliament and resigned by the end of the day. I think that was Hugh Dalton, many decades ago. I mean, those days are long behind us.
And does this £22 billion fiscal black hole that we heard so much about exist or not?
Well, we've put out a report to the OBR which was focused on a particular issue, which was whether at the time of the March budget, when we did our last forecasts, the information we got from the Treasury was giving us the full picture. And we've decided, having talked to the Treasury about what happened back then, that we didn't quite get the full picture. And there was about $9.5 billion of pressures on government spending that were unfunded, and there didn't seem to be a plan at that point to offset them. And our view was that our forecast of government spending this year would have been higher if we'd known that back then. And in particular, we made a judgment back at the time of March that the government was going to underspend its forecast for this year, 24-25, by about 2.9 billion. And it's very likely that we would have at least got rid of that underspend adjustment.
David Miles from the Office for Budget Responsibility discussing their assessment of yesterday's budget with us a little bit earlier. That's it from us for today. If you like the programme, don't forget to subscribe, give it 5 stars so other people can find it on Apple Podcasts, Spotify or wherever you listen.
This episode was produced by James Woolcock and our audio engineer was Stephen Gonzalez. I'm Lizzy Burden.
And I'm Stephen Carroll. We'll be back with more on Monday. This is Bloomberg.
Bloomberg UK Politics. Listen weekdays at noon on DAB Digital Radio in London.